Welcome to Yahoo Finance Live. I'm Shauna Smith along with Inez Frey, and let's get you up to speed on the market action because it has been quite a wild week. The past 4 trading sessions is the highest volume that we have seen of the year for stocks. Taking a look at the losses right now, with the Dow off 435 points, S&P off just about 1.2%, just over 1%. The Nasdaq off just about 1% today. Really broad-based selling. A lot of the pressure that we're seeing has to do with the sales that we're seeing in First Republic, really the losses, I should say. The biggest weekly drop on record for that bank. The company suspending its dividend, even with that $30 billion rescue from the big banks. Analysts still remain skeptical, saying that the company faces a, quote, dire outlook. We're going to talk to a KBW banking analyst in just a few minutes. He says that the rescue deal that First Republic got was, quote, a temporary lifeline. Let's also take a look at some of the other regional players, because you have PacWest, Zions, Fifth Third, among the names under pressure once again today. You're looking at Western Alliance off just about 9.5%, as there are fears still out there about what exactly this contagion risk is and how concerned we should be about some of those regional players. And then also take a look at Credit Suisse, because once again, that stock back in the red this afternoon, off another, 9% today. The latest reporting coming from Reuters that 4 of the major lenders, and that includes Deutsche Bank, has put some restrictions on their trades with Credit Suisse and also its securities there. So that's adding to some of the pressure, some of the selling that we are seeing in that stock this afternoon in us.
And Shauna, oil prices are seeing a steep drop this week, with WTI futures, which settled at $66.74 a barrel. Oil prices have seen 15-month lows. This is because of concerns of a recession that has driven the price of crude lower. Also, U.S. inventories have been up recently. China demand, that has not been as linear as bulls had perhaps thought. Also, the sell-off that we have seen when it comes to the banking sector, when it comes to the whole crisis that we saw in banks, well, banks have had to also, some of them, sell their oil futures to cover losses on put options. So that has also accelerated to the downside some of the losses that we've seen, with Brent futures, which settled today just below $73 a barrel. WTI futures, I just want to show you over the last, I'm going to pull up a 6-day chart here, but for the last week, WTI losing about $10 per barrel. So we haven't seen these prices since December of 2021, Shauna.
Yeah, we certainly haven't. Now the question, of course, is how low will maybe that price fall? We talked to Bob Iaccino of Pathways Trading about this, just the supply picture, how that's really playing into all of this. Let's take a listen to what he had to say just about the drop that we could continue to see in the price of crude.
Those stockpiles you mentioned, Shauna, matter a lot, because you're seeing them not only steadily build, but we're getting closer and closer to being well beyond the 5-year average for this time of year. And if demand falls into that, you could be talking about $45 WTI.
So the question is, of course, what the supply picture is going to look like. That has been steadily increasing now for just about 10 weeks. So there certainly is downside risk here. At least that's how Bob Iaccino sees it. Could be a good news here for the consumer. Also a potential impact here on inflation. Maybe it'll help with the Fed's job of getting inflation under control, but crude will remain a trade that you need to watch next week. Let's talk a little bit more about First Republic Bank, because it has certainly been the story here this week, continuing the slide once again, now off just about 33% in intraday trading. Now that stock dragging the broader market with it. Now this loss here comes despite the fact that the bank did secure a $30 billion lifeline from 11 of the largest U.S. banks. Christopher McGrady, he's head of U.S. Bank Research for KBW, a Stifel company here, to help us break down the action that we've seen over the last week or so. And Chris, it's great to see you again. You had a note out today talking about that rescue package. You characterized it as a temporary lifeline, not a permanent solution. So paint this picture for us and the difference that 1 week has really been for First Republic's balance sheet.
Sure. Thanks for having me back. Yeah, it's been quite a week. You think about a week ago, before Silicon Valley, before Signature Bank, the company was doing just fine. What's transpired over the weekend, we talked about earlier in the week, this deposit run, if you will, from some of these large banks. And what we learned last night with the 30 billion that's coming from the 11 largest banks into First Republic is that the deposit outflows at First Republic have been significant. And so in turn, what the company has had to do is they've had to tap their borrowing capacity to build up liquidity.
So, Chris, what does this do for regional banks as a whole? And is there now a sort of a two-tier system when it comes to banking? The banks that are too big to fail, the banks that are backed, the banks that are seeing inflows, and then the regional banks that perhaps are more susceptible?
Sure. I mean, this feels a bit like a Main Street versus Wall Street dynamic that's playing out, right? You've seen Silicon Valley, which caters to the venture capital community, Signature Bank, which had a big crypto deposit base, and First Republic. This is a very clean company in terms of the balance sheet, but they have a very high net worth customer base. So these are very large deposits. And the concern over the weekend, last weekend, was was the FDIC going to honor the uninsured piece of the deposits? Thankfully, we saw that they did in both Signature and SVB. But for First Republic, the issue here is this balance sheet has really transformed over the last 4 to 5 days, and and many people are talking about the sustainability of this injection.
Yeah. So, Chris, let's talk a little bit more about the sustainability of it. How dire is that outlook?
Right. Let me just put it into context. So what we learned last night was over the last week, borrowings on First Republic's balance sheet have ranged from 20 billion to 109. So a huge increase from their borrowing at the Fed. Now, to put that into context, at the end of the year last year, they had 176 billion of deposits. So a huge range. And what we didn't hear last night, which was, I think, leading to some of the weakness in the stock, is where those borrowing balances are today and where those deposit balances are today. So as analysts, we presume that the borrowing levels are at the higher end and the deposit levels are at the lower end.
And Chris, are there any banks that you like in this space, in the banking sector? I mean, going forward, what is all this going to mean for bank stocks?
Sure. We're seeing into the weekend, investors take down exposures. They're concerned that we've seen failures last weekend, and this is what happened during 2008. Investors didn't want to take too much risk exposure into the weekend, and so we're seeing a sell-off in equities today, and we're seeing a sell-off in the bank stocks. Now, as we talked about earlier in the week, there are some opportunities with this disruption. We've talked about companies like Western Alliance. I see on your screen. This is a company that we actually did a meeting with yesterday. We wrote a note about this morning. They're doing just fine. They had outflows at the beginning of the week. But those have since stabilized. So there's a little bit of the baby in the bathwater dynamic going out within the banks. But down the risk spectrum, there are pure commercial banks that are not high growth, that are very high quality. Some of the names that we really like are East West Bank in California, Wintrust Financial out of Chicago, Old National in Indiana, and Webster Bank in Connecticut. These are traditional commercial banks that grow at a decent rate and aren't caught up in a lot of this volatility.
Yeah, Chris, there's still a lot of risk out there, still a lot of uncertainty. I was talking to the CEO of one of these startups that has had to move their money since last week. There's still a lot of uncertainty just about whether or not, or fear, I should say, that another bank could go under. Do you think we could see another bank failure?
I think that's what the FDIC is trying to prevent, right? If you look at what happened to the First Republic situation, last week they got an additional line from JP Morgan, and they told us at the time they have 70 billion of liquidity. What we learned yesterday was $30 billion from the 11 largest banks in the country were moved onto First Republic's balance sheet. So what they're trying to do is they're trying to stabilize the situation until we know a little bit more about the ramifications of SVB and Silicon Valley.
Chris, if we get another hike from the Fed next week, another 25 basis points, what's the impact on regionals there?
Right. At this point of the cycle, the banks don't want rates to go up any further. So early in the cycle, the banks were what we call asset sensitive, meaning their margins expand as interest rates rise. But given the frequency and how quickly and significantly rates rose last year, at some point, the deposit equation, the repricing of their liabilities exceeds that of their assets. So at this point, the banks really don't want additional rate hikes to flow through. Now, it seems like we may get 25 next week, but I think the signaling will be very important. And I think market expectations, look at the bond market the last few days, yields have come way down. I think the market is taking out the probability of additional hikes, and that's because of the stress we've seen with the last week or so.
Christopher McGratty, KBW, head of U.S. Bank Research, thanks so much for joining us. Now let's talk about the next move for the Fed. CME sees the possibility of a pause in rate hikes for the March meeting at just over 20% as of this afternoon. Our next guest also thinks there's a good chance the Fed will pause rate hikes next week. We have Linda Dessel, Federated Hermes Senior Equity Strategist. Linda, why would no action from the Fed actually be a major move here?
Well, good afternoon, and thanks for having me very much. You know, what the Fed should do next week is 25 basis point or not, it's not that much. But what it is, it's basically they're telling us whether or not they're worried about the financial situation. And, you know, whether they say they're worried or not, things are playing out as they are. And I'm so glad you had the bank analyst on before me, because that is one area of the marketplace that you do not want to have trouble. And so whether they do, and I mean, we at Federated Hermes don't think that they'll raise rates by 25 basis points. Financial stability trumps inflation risk, which will still be there when things settle down here in the banking sector.
Linda, what happens though if we do get that 25 basis point hike? How do you think the equity markets will react?
Mm-hmm. Well, you know, we'll hear what the Fed has to say. Again, 25 basis points is not that much in the scheme of things. Everybody really believes, and we have too believed, that we are near the end of the tightening cycle. But this is a way for them to say whether or not they're concerned, and I think it might just give us another potential buying opportunity, if you will, another bad several days in the market if it sounds like, again, that the Fed is tone deaf as to what's going on and what's really important here.
Linda, just taking a look at our Wi-Fi Interactive, we're looking at XLF right now that is down 3% for the week. It's down 6.9%. The SVB collapse has really been huge for the banking sector. What's happened with First Republic and the lifeline there, what has also happened with Credit Suisse. So banking really volatile this week. Going forward, are you seeing any areas that may be in danger or the next domino to fall, so to speak?
Yeah, well, in terms of the dominoes to fall, when we're looking at the stock market, we believed at Federated Hermes that this would be a volatile year and that we would be trading in the S&P in a wide range, maybe from 3,500 to maybe 4,100. We're at about 3,900 now, so we're at the high end of that range. So the market is not really exhibiting fear, and any fear that's gone on so far in this bear market has been a rolling recession underneath, because the biggest names have come in and been strong. In fact, the big tech names have had a great run here. So what we're looking for is the sort of fear that would get the market, the entire market itself, that fear index, that VIX index, which stays stubbornly below 30. And we've been kind of looking for 40, to say that there was enough fear out there to get a flushing out of this system. Too much money still remains in this system. And too many investors are just not concerned. If you were in the financial services area, yeah, you would be. But if you were buying tech stocks, you'd be very proud of yourself, this week. And if you were out there shopping, I mean, the consumer is extremely strong. Unemployment claims are extremely low. And in fact, around the world, you're starting to see actually economic recovery and not a recession. Most people feel good. So, as we make our way through this particular time right now, we Godspeed that they're able to ring fence this situation, but we might just really need that kind of a fear to roll its way through and give us a flushing out that we think this mess requires.
Well, Linda, when you talk about that flushing out, I mean, how bad could it get with SVB's collapse? Is that a signal that maybe there's a little bit more potential danger, risk, a possible other failure there?
Yeah. Well, the big concern, and people have been saying this is not, this is not new news that private banking would be potentially the next black swan, the next big problem to show itself. And it's no wonder that this is where it's showing itself now in terms of the various banks that are being hit. But when you see a company like Credit Suisse, which of course is a global company, one of the largest banks in the world, and it has had troubles over the years, when you see a company like that on the verge. This is the type of domino theory that could go on, the type of thing that happened really back in 87. A lot of people weren't around then. I was around then. And at that time, the Fed was hiking rates into a strong economy, just like what we have now. And they stopped and they actually cut rates for a while until things settled down, which they will do here again. And then they start raising rates again. When all this is said and done, we're still going to have an inflationary problem. There's a very tight job market. And we at Federated Hermes believe cash is now king and defensive investing is the way to go. Let's not look at this, as a buying of the dips, which we still are doing.
Linda, if
I could throw in one last comment here about that, global ETFs. Global exchange traded funds, ETFs, in this last week have had their eighth largest inflow in their histories. They've been counted in any tough pullback in the stock market. People want to buy the dips, and that's what we've been waiting to see. That just settle down here. Got to flush out.
Yeah, Linda, even though people are buying the dips, there is still a lot of concern out there. There has been some comparisons drawn to this week and comparing that to what we saw back in 2008. I know the situation is very different, but I want to make it very clear for our viewers. Can you give us just one single reason as to why today and this situation with Silicon Valley Bank and some of the other regionals, why that is so different than what we saw in 2008?
Well, it is definitely very, very different. The banking sector as a whole, which was determined to be of a systemic risk, that is the biggest banks, are far stronger. Their balance sheets are far, far stronger than what they were back at that time. No matter whether people decide to sell shares of bank stock, particularly the biggest ones, this is, as you have said, and as your previous guest has said, this is about the regional banks that are not ring-fenced, if you will, that are not nearly as strong in terms of their balance sheet strength. The financial system in this country is in great shape, and actually around the world is in great shape. That is a remnant of 2008. We don't need to be fearing that, not at all. But fear is one of those things, and watch and see what happens over the weekend. People will sell now and worry about it later, no matter what we say. And that is a very healthy thing, really, after an extremely strong bull market. We pulled back at the worst 25% last year. That's nothing more than a garden variety pullback. And we really deserve more than that with this historic spending money from out of nowhere that we have done, and an inflation problem that's gone on, for a while now here, the highest in 40 years. So, a long-term investor is going to get some really good opportunities in here, but we need to be patient. Basically, what we're suggesting at Federated Hermes is humility. Don't think you can call how this is all going to work out, and then patience. And you may get some really good opportunities here.
Yeah, very, very important. Words of advice, and also that distinction between this week and 2008. Linda Dissel, always great to have you. Thanks so much for joining us. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, it's not just stocks that have had quite a wild week. Bitcoin, steady gains there, on track for its best week that we've seen in just over 2 years. We're going to have more on that next. Plus, investors are buzzing about Bumble. You're looking at gains of just about 3%. Citi saying now is the time to buy. We're going to hear from the analyst behind that call. And Okta CEO Todd McKinnon telling us what's next for the identity software company. Don't go anywhere. All right, crypto resuming its rally. Bitcoin climbing above 26,000 for the second time this week. We're on track for the best week that we've seen in just over 2 years. We want to bring in David Hollerith to break down the action that we've seen. And David, it seems like investors are turning to crypto in a time where there's so much uncertainty.
Yeah, Shauna, I mean, we saw Bitcoin begin to rise a lot yesterday, and this was around the time, where the U.S. banking system, was getting sort of this infusion we were seeing with First Republic, and it's hard ever to figure out what exactly is driving the Bitcoin price. But it's continued that rally into today, and Bitcoin's been achieving new price highs, or sort of, for the past couple of weeks. Obviously, the end of last year was pretty rough for it. That being said, when the Silicon Valley Bank seizure happened exactly a week ago, we saw it plummet over uncertainty around how that might impact the market. And there's the industry in the U.S. has had, its two major banking partners close. So now at this point, it's at a very interesting point, as stocks are also rallying, particularly technology stocks. So there's that. And there's a lot of there's sort of a growing camp of people who are looking at what's going on in the U.S. banking system and trying to anticipate what the Fed might be doing from here on out. So that's in play too. But in general, this is a really interesting time to pay attention to Bitcoin, as it was created, at least arguably, during the 2007 to 2009 financial crisis. And during that period, I mean, the idea was that to create a currency and banking solution that was out of the reach of governments. And obviously that's an interesting thing here, because you can look at how Bitcoin may have benefited from the government stepping in to backstop some of these banks in a certain way, if you just track it with the price. So it's a very interesting time. I mean, I think that the thing that needs to be paid attention to is that Bitcoin is right now, it makes 46% of the total crypto market, and it hasn't achieved that high since June 2022. And during that time, crypto was sort of dealing with its own credit crisis, and that was seen as a flight to safety. And at this point, it doesn't seem like investors are scared as much, but it does seem like Bitcoin is rallying a lot more than the other coins.
And Dave, crypto-related stocks, Coinbase is reportedly in talks with clients about a new overseas venue. What's the significance behind this potential move?
Yeah, using three unnamed sources, Bloomberg put this story out today. And this is basically that institutional clients were said to be approached by Coinbase for potentially doing, what we would consider in the U.S. to be an offshore trading venue. And international expansion for Coinbase has been something they've been doing for years. Like Robinhood, for example, which is trying to launch in the UK by the end of the year, they've made that commitment. These companies, like their mission is, in so many words, to democratize finance. That's really only achieved by going all over the world, especially in places where banking or local currencies aren't hitting the mark as much. But Coinbase obviously is dealing with a few other things. It's already in 100 countries. So this is different in that they're talking about creating an actual different operating entity, is what it sounds like from the information we have. Obviously, it's not really been extrapolated for us by Coinbase. They've declined to comment. But we'll want to pay attention to this, especially in light of the fact that U.S. regulatory crypto legislation has not really been moved forward, and it has progressed in other countries, such as in Europe and Asia.
Coinbase is up 12% right now, up 43% over the last 5 days. David Hollerith, thanks so much for joining us. And coming up, Citi believes Bumble shares could soar by about 20% over the next year. Find out why next.
Let's do a quick check of the markets with just about a half hour to go in the trading day. The Dow off 372 points, S&P off just about 1%, the Nasdaq off 0.6%. So wide-based selling here, but all three of the major averages off their lows of the day. Now this market check sponsored by Tasty Trade. Citi is bullish on Bumble, the banking giant, initiating coverage on the stock with a buy rating and a $24 price target. Joining us now, we've got the analyst behind that call, Yigal Arounian. He's the director of Internet Equity Research at Citi. Yigal, it's great to see you here. So Bumble, if you take a look at the performance, off over 30% over the past year, hasn't done much since the start of the year. Why do you like them?
Yeah, sure. Thanks for having me on. Look, I think Bumble's in a place right now where they have a number of product initiatives that were delayed later in the later part of last year. They took some time to get out. They're out now. We think some of those things are going to start to drive better conversion and better user growth. We also just like how Bumble is positioned within the online dating landscape. They've been it's been taking share quite materially from Tinder and some of the other apps over the last couple of years. We think they can continue that share gain. A lot of the brand message from Bumble really resonates well, particularly with younger audiences. We think that app is well positioned to take share within online dating, and that's really the crux of why we like it here right now.
Yigal, and talk to us a little bit about the differentiator that Bumble has, which is women first, as far as the origin women first, and compare that to, for example, Match. I know that you also cover Match.
Yeah, so that women first differentiation for Bumble really goes a long way. I think it's a big part of the brand resonance. It tends to do better with women, and as we all know, that having a good kind of equilibrium between men and women on the app goes a long way to improving the experience. The brand also tends to resonate a little bit better with younger audiences right now, and there's a lot of focus on kind of Gen Z and getting Gen Z to adapt one app over the other right now. For Match, it's by far biggest asset that is Tinder, and really Tinder is the biggest dating app within that online dating ecosystem by a wide margin. And it's seeing some opposite kind of momentum there. It's lost subscribers last quarter. It's expected to lose them again this quarter. Some specific dynamics going on there, but in general, it's been losing share of time spent on the amount of time people spend on dating apps overall. It's lost some share. It's lost some share internally to another Match app, Hinge, but it's also lost some of that share to Bumble. So right now what we're seeing is a big battle for market share. Overall, the amount of time spent on these dating apps overall has really been flat to slightly down over the last couple of years. So we've feel like maybe have hit some level of cap on the amount of time people are willing to spend on the apps overall, and that's why this shift in market share has become really important.
Yigal, there's lots of debate out there about whether or not dating apps like Bumble are recession-proof. What do you think?
Mildly, maybe. Certainly not the most sensitive to recession. That said, there are certain demographics that are more exposed to it than others across the different apps. So in some cases, yes, you do see, and you did see a lower propensity to spend at the onset of some of the macro challenges that we've seen. There's some pressure on the amount of subscriptions and how much people are willing to spend on subscriptions. That's stabilized to a certain extent, so it's still lower than it was when times were better. It hasn't gotten incrementally worse. So there's some kind of base level that people are willing to spend, to meet people and go out and try to find the right person. But there is also a limit to how much they're willing to spend, and people do tighten up their wallets to a certain extent, even for online dating.
Yeah, and Yigal, to that end, because the focal point here for Bumble, for Match, or really any of these players within the space, is the focus, or should the focal point be on the conversion to a paying user? Is that just as important as really growing that overall user base, given the fact that this industry seems to be at least maturing, at least here in the U.S.?
I think it's even more important. And you're right, the industry is maturing more in the U.S. than it is internationally. Although there's a debate to what the right level of maturity, or how mature they can get in international markets, just because the consumer behavior around dating apps is so different market by market. So I think in general you are seeing some upside limit to how many users we see collectively here. The other thing that's happened is the space has gotten more competitive. When Tinder first blew up, it was really the only large dating app that was geared towards younger audiences, and now you're seeing more and more of those. So the landscape's gotten more fragmented, and as people spend time on more apps than they used to, it's not all incremental. So some of the time that you're going to spend on one app is going to likely come at the expense on another app. So that conversion of those free users to paying users, I think, is as important as it's ever been in this space. And it's largely because of that point that we are at, I'm not going to call it full maturity, but there's some level of maturity that we've seen over the past number of years. And there's a lot of focus on conversion right now.
Yigal Arounian, City Director of Internet Equity Research, thanks so much for joining us. And coming up, shares of Warner Brothers Discovery are up after receiving 2 upgrades. We'll tell you what's factoring into the optimism next.
It's time for a triple play. 3 stocks that we're watching in the final half hour of trading. We've got Baidu, Warner Brothers Discovery, and XPeng. Let's kick it off with Baidu because those shares bucking the downward trend that we're seeing in the broader market today, actually up just about 5.5%. The gain here coming after the company unveiled its AI chatbot, which they called Ernie. While the service is not available for the public just yet, Baidu executives did say that Ernie does have the ability to understand the Chinese language, also write, and it can even do mathematical calculations. Probably sounds very similar to the capabilities of ChatGPT. Well, the street, it looks like it was pretty impressed with Ernie, at least the first look at it. Bank of America saying that it tested Ernie and was, quote, satisfied with the results. Jeffrey saying that the company's, quote, early mover advantage stands out to them. So once again, Baidu, the latest company here, Ali, where we're seeing all that excitement around AI, around the chatbot. We had Microsoft, Salesforce, Google, just some of the names here that are putting more of an emphasis on this space. And at least it looks like for now, the street rewarding them for that.
Yeah, and it's going to be interesting how this AI race plays out between China and the United States. You just mentioned some of those companies that are heavily leaning into their own artificial intelligence offerings. I will say that I did read there were some reports of users and analysts that tested Ernie, and the fact that there wasn't a live demo during Baidu's presentation, that perhaps that suggested it didn't live up to ChatGPT. So it's clear the stakes could never be higher. The expectations are incredibly high. All eyes are going to be on these products, and I think we're going to see a lot of serious developments over the next several years.
And your triple play
Yes. My triple play is Warner Brothers Discovery. The stock is seeing a boost after 2 upgrades on Wall Street this morning, citing optimism surrounding WBD's execution strategy and improvements on cost synergies. Analysts at both Wells Fargo and Wolfe Research upgraded shares to overweight and outperform respectively and raised their price targets to $20 a share. Wolfe's Peter Supino said after a rife 2022, quote, "The skeletons in Warner's closet have been accounted for, and that the streaming giant is getting their sea legs." Wells Fargo's Steve Keyhall said the question for WBD is not the bull case, but the bear case. And if the company can execute well amid macro headwinds, the stock can, quote, absolutely work. So it feels like, guys, the word on the street, at least right now, is Warner Brothers Discovery. It's so bad that it might just be good. So that's what I got from these.
Well, I think it's going to be so interesting to see how they bundle their services and all the details that are going to go into that, because we're supposed to get more details on that in April.
Exactly. And Steve Keyhall, he did say that they were potentially undervalued in the streaming space with their DTC offerings. So I think investors are really going to be looking for that.
DTC offerings was one of those things that Wells Fargo did call out in that note. It's been so interesting just to see the sentiment shift when we're talking about Warner Brothers Discovery. Now it seems like it's almost every week that comes about that there's a new analyst call on the stock, someone upgrading the stock, really a more positive view of it. And another thing that stuck out to me was from Wolfe Research, talking about the transparency. They're seeing greater visibility into the internal workings here of the company, giving them a little bit more comfort just in terms of the direction of Warner Brothers Discovery, but certainly a very competitive landscape. So they had their work cut out for them, but at least for now, the street's very positive.
There's another company that has its work cut out for them. It's XPeng. That stock is jumping today. The Chinese EV maker posted a loss per share of 20 cents for its latest quarter, with sales coming in noticeably lower than the same period last year. But the stock is up today because the startup has announced cost-cutting measures and also restructuring measures going forward. So in recent months, XPeng vehicles haven't been selling as well because of competition. Tesla lowered its prices for its vehicles, and XPeng followed suit as well. So shares are down about 89% from their record of $74 back in November 2020. The Chinese market is much more competitive than here in the U.S. The EV adoption is greater in China than in the U.S. and the competition, though, in China is fierce. Tesla is still seen as the top tier along with NIO as well. And it's been uphill for XPeng because even though they did well last year, they are seeing a slowdown. They have had to lower their prices to sort of, because if they can't have prices higher than Tesla's.
Yeah, certainly. We saw the pressure on their margins, hence the pressure that we saw in XPeng's latest results here. Also, their revenue down 40% year over year. The delivery is a significant hit for this past quarter. It's also supposed to drop, almost 50% in the current quarter when we're talking about the expectation now 18 to 19,000. You're right. When you look over to China, certainly it's a different competition picture when it comes to EVs. Lots of stiff competition from those Chinese companies. Tesla making its way there too, picking up some of that market share, just really complicates the whole spending factor, the whole, I guess, outlook here for that company. And XPeng actually pushed out its view for profitability out to 2025. And that really just paints or illustrates the competitiveness of that market right now.
It's a tough market. But I do think when you hear words restructuring, when you hear layoffs, when you hear anything like that, you're going to be rewarded on the street, because right now that focus is on profitability. We're just talking about how much competition is in the EV space, especially new competition. So any sign that you can improve those margins, that's what investors want to hear. here.
Yeah, we will also see if they're able to improve those deliveries anytime soon. Okay, well, coming up next, the regional bank crisis. It has some investors worried about what their retirement funds are going to look like or the impact there. Find out what you need to do to protect your savings next.
It's been a tough week for investors reacting to volatility in the banking system. You may be wondering what the crisis means for your money, short and long term. Joining us now as part of our Retirement Ready segment brought to you by E-Trade is Echo Huang, Echo Wealth Management Financial Advisor. Echo, I'm curious to what type of calls you have been fielding from clients this week and how you're advising them amid the banking turmoil that we've seen.
Well, interesting enough, I actually have not received any calls from my clients, perhaps because we have done the planning well. And of course, in my opinion, that the government will do their best to work with FDIC to reduce damages. And with our client, we have done planning to have enough emergency fund in one or two banks. So in the short term, they won't run into that issue. Of course, secondly, is they always need to pay attention to the short-term cash flow projection. That's what we review on a regular basis, is where do they get the money to pay the bills for the next 3 to 5 years? And that is the money should not be invested in the stock market without any downside protection. So I have not received calls from clients asking that kind of questions. I manage more than $155 million for 100 clients. So I think the planning ahead to deal with this kind of market crash probably has contributed to, I would say this is a good situation we are facing at this moment.
Yeah, it sounds like you guys are actually positioned pretty well, and you've got a lot of trust here from your clients, because I was reading some of the stats. 80% of your clients are in their 50s and 60s, so really not too far from that retirement age. You talk about the fact that a lot of their money is protected because of how you have diversified their portfolio. What do people need to keep in mind in order to not be concerned when an event like this, what we've seen over the last couple of days, happens?
Yeah, the process I go through is, first, we need to create a financial roadmap for each client using Echo Dashboard, meaning that we need to show them cash flow projections to age 55 so they can easily see how much money they need to save for retirement, what does retirement look like in terms of withdrawal, when they need to withdraw and by how much. And so secondly, I think it's really important to use the right tool. We use risk allies to assess clients' willingness to take a risk. So each of them will have a risk number. And then I also use the financial planning tool to assess their capacity for risk based on the time horizon and the withdrawal amount and required rate of return to achieve their goals. And once we talk about those two risk numbers, then we go through this stress test to look at hypothetical models. You could imagine that we could go very aggressive to 100% in the stock market, or we could go 20 to 30% in the stock market. And we want to show clients what happened if financial crisis like 2008 and 2009 happen, how much this hypothetical model would have lost. So sometimes people look at that, they are kind of shocked and say, well, if I don't do anything or make changes to this model, I could actually tolerate 40 to 50% losses during a bad bear market. So then we tweak the portfolio to the right type of asset allocation. I will go into a little bit detail so that clients understand that, okay, I cannot tolerate 40 to 50% loss during a bad market, but potentially I could tolerate 25% loss or 30% loss. Then we can show the long-term projected return for this type of portfolio that may not be too aggressive, but still help them outpace inflation, achieve their goals. So I feel like today is a perfect time to talk about whether each person has the right type of risk in their portfolio. Diversification is the key, but I think a lot of people may not be paying attention to how diversified their portfolios are, and they may be shocked when the markets are very volatile. So that's what I want to talk about is a few ideas on how to diversify further in clients' portfolio.
Okay, Echo, we have about 30 seconds here. What are the quick ideas?
Quick idea is make sure people who are closer to retirement, 5 to 10 years, consider fixed index annuity that has a guaranteed income so that they can have a piece of their portfolio generating guaranteed lifetime income. Another idea is to make sure they have real estate allocation and also buffer funds, because they also can help you reduce losses. And studies shows that 10 to 20% of uncorrelated assets can reduce the risk in a significant way in your portfolio.
Yeah. Echo Wong, great advice there. Thanks so much for joining us. Have a good weekend.
You're very welcome. Have a great day. Bye-bye.
Coming up, Bentley posting a banner year in 2022, trying to find out what drove the automaker to record profits when we come back.
We've been in Austin, Texas, here for South by Southwest, evaluating all things that the city has to offer: good music, good barbecue, and of course, a lot of technology, folks. Here's one thing that you need to know about South by Southwest if you are looking for a vibe check today. Everyone is speaking about what the future looks like for artificial intelligence. There's deal making happening here. And yes, there are a few good parties. We can talk about that because let's be real, they're happening. But all of that aside, the vibe has been good. Everyone is trying to figure out what is the next technology that's not just going to be profitable in the future, but perhaps change our everyday lives. We've had the opportunity to speak with the mayor of Austin, Texas, who gave us a little bit of insight into how this city is competing with Silicon Valley through its own version they call Silicon Hills.
There's a reference to our beautiful hills west of Austin here. Silicon Hills continues to grow and it continues to expand and in different ways.
There's a lot of things that make Austin weird, and they're trying to keep Austin weird. Oh yeah, that's the slogan, you betcha. But we've also spoke to Eve Air Mobility. We spoke to Icon 3D. They're printing 3D homes. You're going to drastically cut down the costs for homeowners by 2 to 3 times, they say. What you need to take away from this is everybody in some form or another is trying to figure out where artificial intelligence plays a role in their business model. And a lot of that artificial intelligence conversation It should be reframed as augmented intelligence if you were to ask chess master, grand chess master, Gary Kasparov, and the chief product officer over at Shutterstock, who is also going to be incorporating this into their business. If you wonder why, the companies of mega cap techs are plastered all over the skylines here with their logos of Indeed, of Google, of Silicon Labs. Here's why. It's because that they believe Austin staying weird enough for them to get innovative and freaky with the technology in the future. And that's what you can count on your everyday life, perhaps being changed as a result of something that comes out of Austin, Texas in the near future, and perhaps because of one of the deals that's happened here in 2023 at South by Southwest.
Bentley having its best financial results here, best year for fiscal year 2022. The luxury car company saw an 82% rise in profit from a 4% increase in volume. They sold a record number of cars, just over 15,000. Yahoo Finance's senior autos reporter Praz Subramanian is here. And Praz, when you take into account the greater aspect, the macro environment right now, you think people might be pulling back on their purchases of Bentley, but doesn't seem to be the case this time around.
No, I mean, you mentioned, huge operating profit numbers there. Revenue up 20%, just a big blowout year for them. Just also the fact that you mentioned macro headwinds hitting them too. So I spoke to CEO Adrian Hallmark about that. He said that, we had a blowout year, but there was a number of challenges. For instance, they had 4 separate production issues that they're able to kind of work around to actually get that highest volume ever that year. Only 4% higher, but then they had 80% more profit. So just a big year for them. And really what drove that is the high-end luxury consumer. Talking about how these consumers didn't really, in the face of macro headwinds, they were still wanting to buy their cars, still spec these cars with higher options. For instance, they're talking about options like diamond cross stitching that they expected a 25% take rate. Over 90% of people wanted that, right? Also, they have a rotating sort of bezel in the gauge cluster that goes from digital to analog to wood, a very expensive feature. Again, 20% take rate. They thought 90% actually wanted it. So people were actually wanting to spend more on these higher priced cars, and that really boosted their bottom line.
Praz, we're also watching shares of Ford right now. They were down more than 4.5%. This is after the company announced a recall. So tell us about that.
We wrote about this a couple weeks ago about how Ford is suffering from recalls. They have the most cars recalled since 2022 of any manufacturer. So in this case, 1.3 million cars recalled for a brake line failure for Lincoln MKX and Ford Fusion. This is a big safety issue, right? Because it's basically stopping becomes much harder without brake fluid. So big problem here. Now Ford says only 2% of cars have this issue potentially. One crash so far, but still that's 26,000 vehicles that will potentially have a problem. So they're going to fix that. Also separately, they had 220,000 F-150s with a lesser issue, a windshield wiper motor problem. Not the end of the world there, but still a safety issue nonetheless.
Praz Subramanian, thanks so much and have a good weekend. And coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. And we're moments away from the closing bell on Wall Street. Just taking a look at the markets right now with 1 minute to go with trading. We're looking at the Dow that's down more than 1%, down about 400 points. The Nasdaq down 0.7%, and the S&P 500 down more than 1%. Over the last 5 days, it looks like the S&P will end in the green for the last 5 days. The Nasdaq gaining more than 4% for the last 5 days, and the Dow down about 0.1% over the last week. And looking at the sectors, we are seeing financials getting hit. Real estate, industrials are also lagging the most. And over the last 5 days, energy and financials are the biggest laggards. Here's the closing bell on Wall Street.
All right, well, that does it for today's trading action, and really wrapping up quite a wild week for the markets. Dow, S&P, and Nasdaq, at least for today, ending in the red. The Dow off just over 1%, as well as the S&P. The Nasdaq off about 0.7%. We got to talk about some of these larger movers. Nessa was just talking about the losses that we're seeing in financials. Financials has certainly been the story today, and this market check sponsored by Tasty Trade. Let's dig into some of those big movers of the week, and we got to start with First Republic, because that certainly is the story as we wrap up this week. Selling off once again today. You're looking at losses of 33% today alone. There's still a lot of worry out there, clearly, about the possible contagion risk. Well, First Republic has lost more than 2/3 of its value this week. On Thursday, 11 U.S. banks, including JP Morgan, Citi, Bank of America, all deposited $30 billion into First Republic. The effort here to restore confidence in First Republic coming after the collapse of Signature Bank on Sunday, Silicon Valley Bank last Friday. Now, Silicon Valley Bank's parent company, SVB Financial Group, they filed for Chapter 11 bankruptcy today. Bank stocks ending the week lower and then the day lower. You can see that on your screen with most of the larger banks off just over 3% today. But we got to talk about regionals, because that's really where the story is. Heavy selling across the board. You have PacWest off nearly 19% today. Zions Bancorp off another 6%, almost 7%, a 15% drop in Western Alliance. And it is when you talk about the fact that, yes, this move, this rescue plan, this rescue package from 11 of the largest banks, it was meant to help shore up some of the concern out there on the street, some of the worry about the contagion risk. But still, when you take a look at their action today, also the fact that the company suspended its dividend, the outlook looks pretty dire. And we heard that from KBW banking analyst Chris McGrady earlier in the show. He was saying that this rescue deal for First Republic, it was just a temporary lifeline. And there's certainly a lot of weakness within that company, a lot of weakness more broadly speaking, and some other names within this space, and certainly something to keep an eye on here.
Yeah, because we don't know the exact details of that lifeline that was given by the banks to First Republic. And so what will that do to the bottom line for First Republic? And you're seeing that reflected with the stock today. You are seeing also over the last 5 days, I'm pulling up on the Wi-Fi Interactive, First Republic is down 71% for the last 5 days. And a lot of questions also about what has happened with banking over the last week, and if what's happened with SVB, what's happened with First Republic, if this crisis has sort of created a two-tier system when it comes to banks. Taking a look also at what's happening with Meta. Shares of Meta ending the day is slightly lower. This comes after CEO Mark Zuckerberg announced 10,000 job cuts on Tuesday. There you see it on the screens. Meta down for the day. Meta had already laid off 11,000 employees back in November, and Zuckerberg branding 2023 as the, quote, year of efficiency. The company also closing an additional 5,000 open roles that hadn't been filled yet. Zuckerberg in a statement writing, quote, this will be tough and there's no way around that. Meta will undergo additional restructuring over the next couple of months, and the cost-cutting measures clearly having a positive impact on investors. The stock ending the week up 10%. Though today it was lower. But look, Meta has been now focusing on AI much more. That is the first and foremost focus because of this craze that we have also seen in AI. It is rebuilding building its tools when it comes to its reliance on user data for advertising. And yes, it is still involved with metaverse, the VR metaverse strategy that had been announced last year. That is a strategy, but it's very capital intensive. That is their North Star, but nonetheless, AI is now taking the forefront.
Yeah, look, it's a year of efficiency. This is clearly a follow through on the message that we heard from Mark Zuckerberg in the last earnings call. We talked to Brent Thill. He's an analyst with Jefferies that covers Meta, got his reaction to these cuts. And I want to play a quick clip for what he had to tell us.
The expense structure was way ahead of the revenue growth. So I think what we're doing now is bringing the expense structure down to where growth is at. And so, they've cut effectively almost $10 billion of expense out, which just tells you, how overweight they were on potentially unnecessary roles. We've said this repeatedly, tech is overhired. There's a lot more cuts to come. This is not the last cut.
Meta clearly not alone in the tech cutting picture here. A number of the larger firms announcing massive layoffs. Those names include Amazon, Salesforce, a couple other names there. Zoom was one of the smaller players in this space, but has actually announced a couple of rounds of layoffs. When it comes to Meta, efficiency, certainly the name of the game at this point. Zuckerberg in an internal email really talking about some of the advantages of a leaner organization, weeding out some of the employees, the fact that they overhired by such a significant amount, really readjusting the company for a more realistic, or really what the company needs to be scaled to in this time of a macroeconomic environment, the time of a lot of uncertainty, significant pullback here. But that shift to AI, and that has really been the story. And that has what it looks like at this point gotten more investors back on board with the company, with the stock off to a tremendous start to the year. All right, let's also take a look at FedEx. That's our final mover of the week. Shares ending today up just about 8%, that big pop higher coming after upbeat guidance here from the company. FedEx's full year earnings forecast coming in stronger than expected. It sees adjusted earnings per share between $14.60 to $15.20. Well, that's up from its prior forecast of between $13 and $14. FedEx claiming that cost-cutting measures here will offset some of that demand weakness, some of the weakness that we are seeing in the packaging space. And Thursday, we did hear from Anthony DeRuyter following these results ahead of the earnings call. He's of ThirdBridge, and he was a little bit skeptical about that cost-cutting plan, wanted a little bit more details over the next 6 weeks. Let's take a listen to what he had to say.
There's a big reward seemingly from investors for pulling off the cost-cutting actions. So it really comes down to are people telling us that FedEx has to be more clear on what they're planning for these big cost cuts. So for example, Drive, the big Drive program for fiscal 2024, $4 billion in savings. Where is that going to come from?
Some skepticism there, although I don't know if skepticism is really fair. I think we're just looking for more details. Anthony is there. But when it comes to the broader street reaction, Citi, which has a buy rating on the stock, raised its price target to $275 a share. Cowen was also positive on these results, saying that FedEx is well positioned to see improving results in the second half of the calendar year this year and also into next year. So we're seeing that reaction in shares today. The stock closing up just about 8% in S.
Yeah, that's right. And a lot of the cost cutting that they are doing is with Express, their air carrier. So they've reduced flights. They have parked some older planes as customers are shifting more now to cargo and ships after the whole supply chain snags have been sort of cleared away. So a lot of questions, though, about how this cost cutting will go forward. It's been a wild week, though, for the markets, with the collapse of Silicon Valley Bank unleashing chaos across the globe and panic rippling through the financial sector. Here to discuss the banking turmoil is Liz Ann Saunders, Charles Schwab Chief Investment Strategist. Liz Ann, thanks so much for joining us. So what's your reaction to what we saw in the banking sector this week?
So this is more of a liquidity issue than it is a credit issue. And I think that's an important distinction we need to make relative to 2008, because there's been a lot of conflating. And there's been a lot of conflating across the spectrum of how this has been reported, including the conflating of FDIC and SIPC. So We're in this social media era where information flow happens unbelievably quickly. Social media can fuel a bank run, and everybody's scrambling to try to get the accurate story. But what we also saw was the Fed stepping in really, really quickly, and that's another important distinction relative to 2008. In a good way. And when you looked at the take up in terms of loans from the Fed that came out yesterday at almost $320 billion, that suggests that the programs are working. That's not necessarily a sort of a shiny penny story, because it means that there are liquidity and funding issues. But I also think that this is part and parcel of a broader issue of the end of the era of easy money and the implications that that has, not just for the banking industry, but for startups, for less well-capitalized companies. You're seeing it in layoff announcements, companies that might have to access credit again. And I think this story is just starting to unfold, but clearly the concentration this week has been on the banking side of things.
Yeah, and Lizanne, just quickly sticking with the banking side of it, I think there also is just some of that risk out there, some of that worry, I should say, about the contagion, what that could look like if more banks could fail. Do you think we could see some as a result of the shift that we're seeing just in terms of the money, the liquidity, and that picture that still is true today?
I think the contagion seems to be a bit more on the psychological front than something systemic like during the global financial crisis. And that certainly can feed on itself, but it's also where regulatory bodies and Federal Reserve, as in part a regulatory body, can step in and hopefully try to calm nerves. I think what's adding to the grave uncertainty right now is not just contagion in the banking system, but what's the Fed going to do on Wednesday? And talk about a complicated sort of wrinkle getting thrown into this in advance of the Wednesday finale of the Fed meeting. And so expectations around what the Fed is going to do, terminal rate, when rate cuts would kick in, have been all over the place this year. And that, I think, has been additionally unsettling for markets.
So, Lizanne, what do you think the Fed will do on Wednesday?
I don't know. I think a lot depends on what we see within the banking system. We're not going to get any additional concrete economic information, either broadly on the economy or inflation. So I think it comes down to whether things settle down or whether things start to escalate again over the weekend or into the beginning of the week. So I think that's where the needle will move. Somewhat clearly, it's between doing nothing and 25 basis points. I think 50 is off the table. There's some expecting cuts. I don't think the Fed will do that. But I think where that needle moves is a function of what happens in the banking situation. And 5 days these days is a lot of time.
It certainly is a lot of times. 5 days can really change the entire picture. Lizanne, if we do get a raise, how do you think the equity markets react? What do you think that tells us just about the risk that could potentially still be out there?
To some degree, I think it depends on what Fed Fund futures suggest is priced into expectations going into the meeting. It's not so much what the Fed does that tends to cause market volatility day of. It's if they do something that sort of goes against what was built into market expectations at that point. So I think if a hike gets priced in by the futures curve and then the Fed, comes along with 25, my guess is it would be a pretty dovish hike in that they would address concerns in the banking system. If they don't do anything, then it's a question of how they address how they're going to tackle inflation in the event there continues to be stress in the banking system. So I wouldn't want to be a Fed member right now, I'd say that.
Yeah, certainly always a tough job, but in these situations, even tougher. Lizanne, what does all this tell us just about the risk of a recession? Is that a sure thing at this point?
Yeah, I mean, we were already in a form of recession. I've talked about this on your program, this rolling recession. We have had this asset crunch, and it's hit areas like the mortgage market and housing more broadly, and consumer goods, a lot of the stay-at-home beneficiaries. It just has been offset by strength in services. Do I think ultimately we get an officially declared recession by the NBER? Yes, I think that's the case. We were in a bit of a tightening credit environment before SVB failed. So I think what was an asset crunch is likely to turn into a credit crunch. And that was sort of the missing ingredient. And really the thing that a lot of the pundits that were in the no recession camp were pointing to. Hey, there's no credit crunch. That means no recession. Harder to make that case at this point. So I think recession, yes.
All right, Lizanne, we'll leave it there. Always great to have you. Thanks so much for hopping on with us. We really appreciate it. Have a good weekend.
You too.
All right, well, coming up, those concerns over the financial sector stability could actually end up helping the Fed's fight against inflation. We're going to talk to Rick Newman. He'll break it all down for us next. President Biden's domestic headache, stubborn inflation, well, it might have met its match this week in the chaos that followed the collapse of Silicon Valley Bank and Signature Bank. For more, we're joined by Yahoo Finance senior columnist Rick Newman. So, Rick, help us make sense of all this. You're making the case that the collapse of Silicon Valley Bank, maybe some of that turmoil in the banking sector, could actually help the Fed's fight against inflation.
We have actually seen notable declines in inflation indicators just during the last few days in things like inflation expectations as predicted by the bond market. Now, of course, we got the consumer price index data earlier this week, and that really was not reassuring about inflation. But that's measuring prices from, from several weeks ago, the basket of prices, and it is not capturing what is likely to happen as we get tightening financial conditions and perhaps rapidly tightening financial conditions. So the whole reason the Fed has been raising interest rates is to tighten up on credit, to tighten financial conditions, get people to spend a little bit less. But now out of nowhere, we've got this exogenous shock, the banking crisis, these bank failures, which seems like is going to do exactly that. It is going to lead banks to tighten underwriting standards. That means less credit. That means tighter financial conditions, which is, are exactly the things the Fed is trying to control. And we just had Lizanne Saunders talking about her belief that there will be a recession later this year. So it's very weird. I mean, we're all trying to guess. We're still trying to guess the first order effects of these banking failures, and we're talking here about possible second or third order effects. But in the short term, it is looking like this could be good for getting inflation down.
Now, Rick, how will this impact, though, President Biden's popularity when all of this is said and done?
Well, we have this question hanging out there. Are they bailouts? Are they not bailouts? Which I think is silly semantics. I mean, clearly these are bailouts. I mean, when the government gets involved in the private sector and prevents losses from happening, even when it's not obligated to do that, I think that is a bailout by definition. Voters really hate bailouts because they think that the little guy gets screwed and the rich guy gets saved. So it's now incumbent upon Biden to make this look like it is a good deal for taxpayers. And he's starting out, obviously, by saying, look, there's no taxpayer money involved. That could be true or not true based on whether any of the fees the bank pays to get through this, whether any of that filters down to consumers. If it ever does, you'll never know about it. But it has a lot to do with framing. And I think that's one of the reasons we heard Biden come out today and say he wants Congress to do whatever it takes to hold accountable the executives at these banks, whether that means clawing back previous pay or other things like that. Now, Congress is not going to do that. But Biden is trying to make the case that this needs to happen, and that is all to make it look like it's not taxpayers who are on the hook here. So if this all settles down, I think the banking failures are a non-issue for Biden in terms of his popularity. If it continues to roil markets, he has some work to do to frame this to his advantage.
Because taxpayers don't like bailouts. Rick Newman, thanks so much. That's right.
Bye, guys.
The U.S. Justice Department is investigating TikTok's parent company, ByteDance, over allegations that it spied on U.S. citizens, specifically reporters who were covering the company, according to the New York Times report. The investigation began last year. Yahoo Finance's tech editor is here with more. Dan Howley. Dan?
That's right. And as this goes back to a report that Forbes had done. Now, these are some of the journalists that were spied on, the ones who were writing about this at Forbes, and they say that the DOJ is looking into TikTok. Originally, they had been doing reporting at BuzzFeed where they were about TikTok's internal practices. And so according to them, and frankly, TikTok or ByteDance, there were employees at ByteDance, two in China and some others somewhere, who had looked into these reporters as well as their kind of associates to try to find out where the source of the leaks were. By doing that, they obviously were spying on these journalists and their associates, trying to gather up information. ByteDance went ahead, came forward, said that they did this investigation, that they fired the employees that were involved, and they regret that this happened. Obviously, horrible timing on their part. This is before Biden was calling for them to sell or get lost. This was when they were still trying to negotiate, but we did still have people on both sides of the aisle in Washington saying we need to ban the app. The app was already being banned. So it just comes at an even worse time now that there's this confirmation of this DOJ investigation. They're working with the FBI and the U.S. Attorney of the Eastern District of Virginia. So, what this all means, it's hard to tell. Will they pay a fine? Will there be some kind of penalty? We really don't know. I don't think it's going to come down to the app being banned because of this. We have Biden saying we want it banned. Congress, do something and I'll back it up. Or saying, look, ByteDance has to sell TikTok and divest itself. We do have TikTok's CEO going to Washington next Thursday, and obviously we'll be following that live. I don't expect it to be much except for a dog and pony show where we have a lot of grandstanding. Look, this isn't where the issues are going to be sorted out in this kind of public setting. I think it's really going to come down to whether or not Congress passes something, and then it'll all come down to the courts.
Dan Howley, thanks so much. And coming up, Okta CEO Todd McKinnon tells us how his platform can help users protect themselves amid the banking crisis. Stay tuned.
quite an eventful several days. And we're seeing more banks now experiencing runs on their uninsured deposits. So we may have more shoes to drop here. That's a problem when you do kind of these one-off interventions, bailouts. I would call it a bailout. It makes other banks and other bank depositors jittery.
What do you think this then means for the banking sector going forward?
They blew themselves up the old-fashioned way. Idiots. That's the bottom line. And at the end of the day, they caused chaos in the banking system, and the outcomes now with new policy in place are not good.
Things break. And when things break, that spooks people. And when people are spooked, the economy slows down. When the Fed tightens, stuff happens. That leads to a slowing of the economy.
We're still continuing to digest everything that happened in the aftermath of Silicon Valley Bank.
I don't think it's so clear yet, how this will feed into the broader economy, especially because, relative to what we would have thought 6 months ago, we're still running a really strong economy.
Expectations for rate policy are varying widely as a result of the turmoil. Just days ago, a hike of at least 25 basis points was baked in. Now some analysts see the central bank standing pat next week, and one, Nomura, actually sees a cut as a possibility.
I think the chances of a soft landing are very, very small. That, it's going to be a moderately hard landing or a really hard landing. And that can come in two ways. Inflation numbers still stay high. The Fed increases its hiking. It's an interest rate. Let's slow down. And companies lay off more people. Layoffs lead to people having to sell homes. Homes sales lead to fall in house prices. You get a sort of bad sequence of events. You get a harder landing than the Fed wants. That's still a possibility out there.
Sponsored by Tasty Trade. Again, all three of the major averages closing the day in the red. You have the Dow off just over 1%, as well as the S&P. Some selling here across the board, as there is some risk out there, some worry just about the collapse of Silicon Valley Bank, all the jitters surrounding First Republic Bank, what that could mean here for the banking sector going forward. The Nasdaq closing the day off just about 0.7%. For the week, though, a very different picture. The Nasdaq 100 closing the week up nearly 6%, its biggest weekly gain that we've seen since November. The S&P also rising just about nearly 1.5%, up 1.4% for the week. We'll be right back. Okta shares have soared since the start of the year, up more than 20%. It looks like the company's new focus on efficiency is paying off. Brian Sazi spoke with Okta CEO Todd McKinnon about that strategy shift amid the current macroeconomic environment in terms of uncertainty. Here's what he had to say.
Well, the first thing is our model of recurring subscription is showing leverage. So you build up a great customer base, you have retention that's very strong, you're able to sell that customer base new products that you're developing and innovating on. You layer that on with the growth overall, and it's a model that's generating leverage. With the macroeconomic uncertainty we're all dealing with and growth moderating to some degree, you're seeing us invest proportionately less in sales and marketing, and in many cases that less investment can translate to more profitability.
Is it fair to say that Okta is a more focused business now?
We're pretty ambitious in our plans long term, but I think we have taken some near-term investment away from some growth initiatives and poured that back into profitability, which I think is the right thing for this time of macroeconomic uncertainty.
Talk to us about that macroeconomic uncertainty. Where is it hurting the most? Is it capturing new business?
I'd say a good part of it is caution and prudence for the future. The actual impact in our business that we've talked about in Q3 and Q4 of last year has largely been in two areas. One has been in our SMB segment, so smaller companies not purchasing as much capabilities as we expected, and then more of a shift toward upselling products to existing customers versus landing new customers. So those are the concrete metrics we've seen in our business. But really, we're being prudent about what could change going forward. In our outlook for the future, we're guiding to 16 to 70% revenue growth for FY24, which is the year we're in now. We're being prudent in that outlook, assuming the macroeconomic condition could get worse before it gets better.
Do you think it will get worse just based on the numbers you guys see?
I think we have to be open to the possibility. But what we know is that these long-term trends that we're helping customers with, being secure, workforce efficiency, and digital transformation, are going to be powerful long-term. So when the the uncertainty around the economy clears up, we're going to be ready to go.
This has been a crazy week or two in markets and in finance and in business. It's given me flashbacks to 2008, 2009, but I'm not a security expert. In this environment where up feels down, I mean, do you get calls from other executives saying, hey, are we secure in this environment? What type of questions are you getting?
Well, I think security is one of those evergreen things. Everyone always wants to be secure. It's really a balance between how do we adapt to the world around us? How do we adopt the right technology? How do we do it more efficiently? How do we create new revenue streams where it's appropriate while at the same time being secure? So it's never just about security alone. It's how can we do all the things we want to do to move our business forward, and how can we do all the crazy things you have to do in the world right now to adapt and evolve in the landscape we're in and do it all securely.
You co-founded this company. You're plugged into the tech scene. You've spent your career in the tech industry. It's been a challenging time the past week and a half, especially with fellow folks that have started their own business. Maybe they couldn't get their cash out of Silicon Valley Bank. What is the vibe in your community after an event like this?
I think the last year in tech has been, I would call it more coming off a high, coming off zero interest rates, coming off growth at all costs, coming off a hiring market that was extremely competitive and challenging. I would say now it feels more normal, especially compared to what it was a year or two ago. And I think the thing about tech is there's always an innovation. You see what's happening now with AI technology, and there's always a next wave. And it's about building companies for the long term that can both survive but also adapt and take advantage of the next wave of innovations as they come about.
How will this AI push impact your business?
I think, well, first of all, thinking you know the answer to that is probably underestimating the potential of AI. So what we're trying to do is have a very open mind. And when you look at what's happening with OpenAI and GPT-4 right now, or GPT-4 and then ChatGPT taking that into account, it's the possibilities are endless. And I think the companies with the most open mind that look beyond the obvious use case are the companies that are going to have the advantage, and that's the approach we're taking.
Is this stuff secure? I call it stuff. I'm not even sure what to call it. I'm talking to a computer and it's just writing things for me.
Well, the security is a journey, and it's anytime there's innovation, anytime there's change, there's an opportunity for the people that are trying to be malicious and trying to hack into things to take advantage of the new cracks and the new crevices. And there's also an opportunity for the industry and security vendors to adapt and plug those holes and make the entire ecosystems as secure as ever as it evolves. So that's why it's such a healthy to have a vibrant ecosystem of security vendors. It's why it's frankly dangerous to have security controlled by one large company. You hear about companies trying to build monolithic security stacks that provide all security. We think that's dangerous, and that's why one of the things we're doing in security is not only helping companies with secure login, but we're facilitating better integration between everything in the security suite. So your endpoint technology or your log analysis or your SOC tool all can work better together to provide a more secure environment as the inevitable change and onrush of technology happens.
I had a rude awakening over the past week as all this stuff was unfolding, all the banking crisis stuff. Not a lot of folks in my orbit lived through the last crisis. They weren't covering it. Sometimes they were in elementary school or they were in high school. You lived through it. You fell through it. You managed through the business. Does this feel like that time? And then how have you been leading through this crisis?
Well, I started Okta in 2009, so right in the echoes of the financial crisis.
It was bad.
And
that was bad.
You mentioned small companies earlier. Small companies are so incredibly fragile, and oftentimes they have one bank, and oftentimes they're just trying to strike out and survive. And it's a game of survival. And in some ways, it feels much different to have the scale and the breadth and the size of Okta and the diversity in terms of employees and products and business streams. But it's still one of the inevitables of technology is change, and you have to be able to adapt no matter what size company you are.
Is it key to over-communicate in this environment with employees?
I think that's something that is true all the time. I think if you want to build a culture that is fired up for your mission and trying to achieve collectively what the company can do better, greater than what any one individual can do, you have to have a stream of constant communication and be very clear about where you're going and set the framework for where you're going, but then entrust and empower the team to drive the specifics of that as they see fit.
I don't think I've ever asked you this, and we've talked a lot in the past, but what made you start Okta right essentially near a financial crisis?
It wasn't on purpose. It was just a matter of me thinking the time was right in terms of the evolution of cloud technology. And then that really rise into this need for better identity and better security. Because remember, cloud meant more services, more applications, more accessible computers, or more accessible systems. But it also meant that there were new opportunities for people to break in or people to take advantage of that environment. So we felt it was the perfect time.
That must have been really challenging to get a business off the ground when it felt like the world was collapsing.
We talk about some of the basic things. Like I remember we were worried about getting healthcare and you know, like happening now, like our bank surviving and being single source to one bank. So these things can repeat sometimes.
Well, let's hope we do not get back to those times. Let's just deal with whatever this stuff may be. Okta CEO Todd McKinnon, always great to get some time with you. We appreciate it.
Thanks for having me, Brian.
And it has been a wild week for banks. Let's take a look at where those stocks closed this week, starting with First Republic, ending the week down 72% for the week. Today it was down 33%. Let's also take a look at Credit Suisse, ending the week down 24%, Jana.
Yeah, certainly. And let's take a look at some of those other regionals here, taking a massive hit. First Republic falling more than 70% over the last 5 days. Now, it's the biggest weekly drop on record here for that company. You're seeing really losses across the board with Western Alliance, PacWest Bancorp, also Zions closing the week in the red. And it wasn't just those regional plays, big banks. They also declined. The XLF down almost 6% for the week and for the day. You're looking at JP Morgan, Goldman Sachs, Bank of America, Citi, Wells Fargo, all closing in the red. For a full breakdown on what has been a very eventful week for the banking sector, we want to get over to our very own Rochelle Akufo.
So we're taking a look down memory lane on all the key moments leading up to the current frazzled state of the banking sector in this week's installment of What Just Happened. Now, it begins with Silicon Valley Bank when it proposed selling stock to raise additional capital, leading to clients pulling their money from the bank out of fear as depositors tried to withdraw $42 billion from the institution. Then Treasury Secretary Janet Yellen addressed the Silicon Valley turmoil on March 10th over concerns of SVB.
There are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
However, Yellen making note when convening with financial regulators that the banking system remains resilient. At the same day, Silicon Valley was seized by regulators along with Signature Bank over the same weekend, in which regulators said a systemic risk exception, which allows the government to pay back uninsured depositors. At the start of the week, SVB depositors were given access to their money, followed by investigations opening the next day on SVB's collapse. And in the midst of the fallout of SVB in the US, overseas fears began bubbling over Credit Suisse. Now, the worries of the Swiss bank's viability sent both regional and big bank stocks tumbling once again, with shares of First Republic taking the worst beating, dropping 60% on March 13th. The Treasury Secretary Janet Yellen once again reassuring the safety of the banking system in yesterday's remarks.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
It wasn't long before First Republic was given a lifeline, receiving $30 billion in deposits from other banks, while Credit Suisse is set to receive a $54 billion loan from the Swiss Central Bank. However, the fallout of Silicon Valley Bank continues as its parent company files for Chapter 11 bankruptcy.
There certainly is a lot to digest. Let's get into all of it. For that, we want to bring back in Ken Leon. He's the CFRA's Director of Equity Research. And Ken, it's been about a week since we last talked to you. Lots of stuff has happened within your sector, within the financial sector over the last 7 days. So just break down, I guess, how you are looking at the events of the last week.
Well, it's great to be back here. And we certainly have moved from either idiosyncratic or one or two bank failures to a lot of investor uncertainty really about the banking system. And one of the Fed's mandate is financial stability. And we saw that at work, working with the largest banks on funding for First Republic, but also the liquidity that they're doing between the Fed and the large banks, $450 billion. So what does this all mean? Investors usually are nervous. They don't want to be long for the weekend to perhaps another episode. And then we had Credit Suisse, but CFRA, we've done rigorous reviews of US and European banks. There's fewer larger consolidated banks in Europe and the liquidity position is stronger. The issue and my focus in the US is the third rail of risk, which is really bank supervision. We have roughly 3,600 banks that the Fed regulates. When you go downstream below 200 billion, no less, 10 billion to 100 billion, and there's 99 of those banks, $2.7 trillion. We need more resources, more bank examiners to do the work that the Fed can do. So this is also a people story, and it's going to shift to Congress, and it's going to be in the spotlight in terms of questions as when did this happen? Why did it happen? Is it ring fenced? And what are we doing to make sure it doesn't happen? Or no less a concern about financial stability. Those are the questions.
So, Ken, what could that regulation going forward look like, and will it be focused mostly on the regional bank sector?
Oh, it will be, and it's a really increasing regulation. Again, back in 2018 was the legislation that eased the regulation, so it was only the 8 banks above 250 billion. And we've seen, of course, that laxity has created problems. Since bank failures, we've had 2 of the largest ones, as noted in the past week. But then again, there's lots of other banks where, as Sarah Raskin, former Fed governor, said, this is really Bank Examiner 101. It's looking at deposit mix, it's looking at duration mix, the balance between assets and liabilities, liquidity. All these things took many years for the largest banks to put in place since Dodd-Frank. So when you go downstream to a wide number of banks, it's going to take time, both on the regulated side for the Fed to have staffing, and then on the bank side, because they're going to have to steer some of their investments into compliance and regulation. the large banks, that was many, many hundreds of millions of dollars.
And Ken, when we talk about some of the moves here from regulators over the last week, a lot of that was done to help reassure some of the skeptical investors out there, stop some of that panic. That doesn't, though, seem to be translating when you take a look at some of the action that we're seeing in the market today. So did they go far enough, or is regulation, is that the answer to help shore up some of that concern out there?
100%. You're right. And the market is saying we didn't have enough transparency to these specific bank failures, and whether it's endemic to the regulatory oversight of these smaller banks. And, imagine it, it's not only depositors, but also traditional investors, but hedge funds, long, short, looking as they're a cockroach theory of another bank to fall. Generally, the banks are healthy. The system is healthy. This, as you've chronicled this week, is not the financial crisis of 2008, where it was not only the largest banks, but also the capital markets. This is a little bit different game, and it's going to take some time to unpeel everything and put it in the sunlight.
And Ken, has this crisis created a sort of two-tier system when it comes to banks, the big, too big to fail banks, the banks that are backed, then the smaller regional banks, and going forward, if they do see more regulation, I mean, will it be difficult for them to survive and for their stocks to perform?
Well, they have to survive. So whether you're in Washington and saying that community to small banks play an important role in their local areas, and that is critical. And when you get to the largest banks, obviously they play on a global stage and also have an opportunity here, fortunately or unfortunately, to take increased total assets. So it's not really from a policy standpoint where you want to be. But certainly, whether we look at the Republicans or Democrats, they do want these small banks to be around, and I would agree with that.
All right, Ken Leon, always great to get your perspective. Thanks so much for joining us again. Have a good weekend. All right, well, the recent collapse of Silicon Valley Bank and Signature Banks, they are in the headlines now, but they are just the latest in a long list of bank closures. Take a look at this chart here. It shows the number of bank failures over the last several years. And you can really see how many banks we have had, how many failed during the financial crisis alone. So how did we get here? And is this week's chaos any different than what we've seen in the past? We want to put this all into historical context for you about the banking system in America. And for that, we want to bring in Fordham law professor Richard Squire, as well as Yahoo Finance's David Hollerith. Great to see you both. Professor, just put this into context for us. When we're talking about the failures that we've seen over the past week, how does that stack up to the failures we've seen in the past and just the sheer number of banks that we have today, over 4,000?
Sure. So there were more bank failures in the 2008 crisis. There's no doubt about that. But banking is inherently risky the way we do it in the developed world, where you have a bank that takes deposits that could leave at any time. Depositors can demand deposit, meaning you can demand your money and get it back at any time. And then the bank turns around and vests the depositor money in long-term assets, in a 30-year mortgage or a 10-year treasury bill or a loan to a business that might last a few years. So this is inherently a rickety structure. And when lots of depositors want to pull out their money at the same time, the bank becomes illiquid, it runs out of cash, and often it fails. So what we saw last week at SVB and to a certain extent at Signature was a classic bank run. Now, it has kind of a turbocharged quality to it because depositors can run faster than they ever did before. It's like Fast and Furious in reverse, where you can go from 42 billion to zero in 6.2 seconds by online banking, electronic withdrawals, and so on. But the underlying dynamic and the underlying instability really dates back to the 19th century, if not before.
Yeah, and Richard, on that note, I was going to ask too, I was paying attention to the number of banks in other countries. China has about 187. This is as of the end of 2021. The UK has 365. The EU has about 52 100. So it does vary per population size. But I was curious for the U.S. Where's sort of the debate start? You're getting at it.
Are you talking about the debate in terms of what's the right number of banks?
Yeah, or why so many versus a more consolidated approach?
Right. So there's a couple of stories there that I think are particular to the US that are historically interesting. One is that there was traditionally in the US, and we still have an aspect of this today, a kind of populist concern about big banks, especially big city banks. So by the way, I don't mean Citibank or Citigroup. I mean banks based in the big cities in New York and Chicago, the financial centers. And so during the Civil War, and then for a long time afterward, there were both federal and state laws that limited how big banks could be. Many of them said you have to have just one building. You have to operate out of one building, so one bank branch. And others put restrictions on interstate banking. So there were lots of small local banks, and the bankers had relationships with both the depositors and also with the people who received the loans, the mortgage holders and the businesses and so on. So the scene in It's a Wonderful Life, where the banker is talking to all the depositors lined up and knows all of them. I mean, that is very much an American story. And although those laws have largely been repealed, the branch banking laws, that legacy, I think, continues. And we're still kind of living with an industry structure that reflects those origins. It's also worth noting that FDI insurance subsidizes smaller banks. People would normally say, well, gee, I want to give a bank my money, but I don't want to have it wiped out. And they would think, well, a big international bank is going to be made more stable, more diversified in its investments. Also, now it may be too big to fail. But a smaller bank that would not seem so stable can say, you know what, we have $250,000 of federal insurance money per depositor, just like the big banks do. So your money is safe with us, at least up to that amount. That certainly contributes to the number of banks we have in America.
Yeah, and I know the peak number of banks in the U.S. was like 14,000 around 1930, and so it's been consolidating since then. And I'm sort of curious about what you think of the trend, what you make of it.
So the major statute repealing those federal laws, the main federal law, I should say, that prohibited branch banking was the McFadden Act in 1927. So it's not surprising to me that 1930, just a few years later, was kind of the peak number, and we've seen it decline since. However, during the Great Depression, the Congress helped to create, well, you're pretty young, actually. You might not remember the savings and loans. And there was a crisis that they ran into in the 1980s. But these were smaller banks, again, that were just supposed to take deposits and make local mortgage loans to homeowners and so on. And so even after there was this move toward consolidation with getting rid of the branch banking laws, there was still a subsidy for another type of smaller bank. Now, the savings and loans failed as well in the 1980s. And so we are on this trajectory from 13 or 14,000 100 years ago, approximately, to 4,000 banks approximately now. And I think it's going to keep going down because too big to fail is a real phenomenon. The two banks that just failed famously, or the most visibly, Silicon Valley Bank and Signature Bank, were still fairly big banks by overall American standard. They'd be in the top 1% in terms of assets. And so there is an incentive for smaller banks to try to consolidate to the extent that they can, that regulators will let them. The FTC sometimes tries to block these bank mergers. But there is pressure through too big to fail and the perception that these bigger banks are systemically risky, even just top 40 big, that will make it harder for the smaller banks to survive.
Certainly is a very, very interesting story, and great putting that all into historical context for us. Professor Squire, great to have you. And of course, our thanks to Yahoo Finance reporter David Hollerith as well. Well, coming up, if you thought this week was busy, wait until you see what is on tap for next week. We've got the Fed meeting. That's just one of the things. Stay with us. We'll be right back. It's closing time here at Yahoo Finance. Let's take a look at what we are watching next week. First up, the Fed. The central bank will announce its latest interest rate decision on Wednesday. Prior to the collapse of Silicon Valley Bank, the thinking was that we could see a 25 or maybe even a 50 basis point hike. But the recent turmoil in the banking sector has some investors and strategists questioning if the Fed is even going to raise rates at all. We will bring you that decision, the Fed's decision, at 2 p.m. Eastern Time on Yahoo Finance Live.
And on Thursday, TikTok CEO will be on Capitol Hill to testify before the House Energy and Commerce Committee. The hearing comes after revelations that the Biden administration has told the Chinese owners of the company that they need to sell their stakes or risk being banned in the U.S. However, in an interview with the Wall Street Journal, the CEO says that a sale won't solve lawmakers' security concerns.
Now turning to earnings, Nike is set to report its fiscal third quarter results on Tuesday after the market close. Analysts are expecting the company to report earnings of 54 cents a share on revenue of $11.5 billion. We, of course, will be watching to see what the athletic apparel giant has to say about the health of the consumer, spending patterns, and any insight into potential price hikes. Well, that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here at 3 p.m. Eastern Time on Monday for all your coverage leading up to and after the closing bell. Have a good weekend.